MasTec, this is dog food company, right?
It is, yeah.
Yeah, okay.
So when you're ready. Okay, we're all set.
All right, welcome to the class of 2023 AIM presentations. Second presentation by the junior class. Today I'm pleased to announce that Michael is bringing us MasTec. So you know the routine by now. Michael, if you could talk us through how you picked this company and if there's something out there everyone keeps asking that you'd like to address because it just doesn't seem to get through, or something you feel you'd like to address before we get going. Take us away.
Yeah, thanks, Dr. Wall. So my name is Michael O'Donnell. I'm a junior in the Applied Investment Management program. Today I'll be pitching MasTec, ticker MTZ, with a price target of $126.59, representing 42.71% upside. So kind of how I found the company. So considering this was my first pitch, I just set market cap that would have been acceptable for the small cap portfolio and started looking through industrials companies. And then I found a couple companies that I found pretty interesting. And then from there, I set a FactSet screener that had an ROE at greater than 15%. And then companies that had seen a market correction over the past 3 months and had positive sales growth for fiscal year 2021. From that, I found a company called Cryoport, and I also found MasTec. Cryoport does transportation for life sciences, but they haven't turned profit yet, so I felt like that would be kind of a tough first pitch. So from there, I really focused on MasTec and saw that they had some really strong segments I thought I could pitch and capitalize on. So one question that I've seen a fair amount in D2L was my first risk, which is revenue concentration. As I brought up in Q3 of 21, 34% of their revenues came from their top 3 customers, those being AT&T, NextEra Energy, and Enbridge. So I think it's good to look at in kind of spectrum. So in fiscal year 18, 59% of their top 3 customers, or 59% of the revenues came from their top 3 customers. In fiscal year 19, that was 39%, and then fiscal year 20, it's 26%. And so this year, through the 3 quarters aggregate, it's going to be anywhere from 32 to 35%. Enbridge, they've had it it's been a customer since 2014, pretty substantial customer. So that's an 8-year relationship. AT&T has been a customer anywhere from 50 to 60 years. So if you look in the beginning of my recommendation, Church and Tower was actually voting for Bell Tower Southwest, which later became AT&T. And NextEra Energy is a relatively new client, anywhere from 2 to 3 years. So I will say I think acquisitions help this a lot, especially the Henkels and McCoy acquisition. That's a 100-year company. And of their top 20 customers, 85% of them, 85% have been with them for more than 5 years. And of their top 20 customers, 30% have been with them for over 30 years. So I think that will help kind of with the revenue concentration aspect. And also they have a large part of their contracts coming from master service agreements. Anywhere from 50 to 55% in the coming years will come from those master service agreements. So I'm happy to take any questions as they rise. So.
Take us away.
Yeah, great presentation, Michael. Just wanted to go in a little bit more in depth into your second risk regarding oil and gas move. You say that if the market projections for other segments do not play out as expected, EPS could compress, and clean energy would obviously be that substitution. So can you kind of provide a little bit of color into where clean energy's margin is compared to the oil and gas margin at this current point?
Yeah, so oil and gas is their highest margin segment. So it's ranged anywhere from 17 to 20% historically. Clean energy is a relatively new segment. So in 2017, it was about a $300 million segment, and in fiscal year 21, it's projected to be about $1.9 billion. So as that time horizon has kind of gone on, they've seen times where margins are really good, somewhere in the 8%, and the quarters and fiscal years that are anywhere in the 3 to 4%. And I think management has really talked about as you kind of mature, learn more about the clean energy segment, you're going to see margins really start to level off and become more steady. Communications is 11% margins. Electrical transmission is going to be in the low 10s, and then clean energy I have about coming out to 9% in those out years. So
Perfect, thank you.
Next up.
Yeah, I'm curious on your 18-month backlog. Are they doing anything to kind of address that to speed that up process? Is that just lack of staffing, and is there any risk of losing any customers for that?
Yeah, so I mean, I think the backlog is evidence of 2020, kind of slowing down demand, and then 2021 happens and there's this huge increase in demand because, people want their services. I think one thing is, if you don't have the staff when all this demand is rolling in, you have to create backlog and it goes into backlog. I think the Heckles and McCoy and Trent acquisitions, I mean, that adds 7,100 employees, and I don't think you can add that many employees organically. So I think that will really kind of trim away at, I guess, the risk of, backlog being so large that they just start to lose that momentum that they have.
All right, Don.
Hey, Mike, great pitch. So just can you help me understand on your government spending driver, how you kind of factor that into your thesis for your revenue assumptions from like 2023 to 2026? And I was wondering if you can also give us a little more color on why your operating margins evaporate by about 100 basis in 2022.
Yeah, so I'll kind of work back. So to the operating expense question, or operating margin question, so I guess kind of twofold. The first part being is as they move away from oil and gas, their highest margin segment, you kind of see margins compress in that way. And also with the Heckles and McCoy acquisition. So I highlight a lot that Heckles and McCoy has a pretty large, I think 1.15 billion in their last year's revenues for electrical transmission. But they also have a smaller communications and oil and gas segment, which are 150 million in revenue and 250 million dollars in revenue respectively. So those two segments have they've hampered on business. They had two jobs, one in each segment, that really kind of underperformed, and that caused margins to really shrink. So in 2022, I kind of factored that into my communications, oil and gas segment margins. And then as you kind of see synergies play out, they start to expand. With regards to the government spending question, I think it's good to look at. So from 2014 to 2019, their 5-year CAGR of revenue was 9.27%. And throughout my DCF, I have it growing at 10.44. So that's an 83 bip spread. I mean, I didn't want to factor in too much of the government spending, given that it's most likely going to be deployed in 2023. And I felt like I didn't have proper visibility to say, I think they can capture X amount of spending from the government. I will say, I think it provides a lot of tailwind for it. So.
Yeah, I also say, nice presentation, well written, and I think as you read through these, you can at times see effort that's gone into it, so I want to be complimentary of this. I know this was addressed, but I think it's important. This company has a substantial amount of debt. Now, not that much more than the industry, but we're moving into a period of these higher interest rates. And over the years, we haven't had to worry as much about capital structure when we're evaluating companies. I think we do need to be aware of that right now. What do you know about their debt, when it's coming due, how it's structured, and do you have any concerns?
Yeah, so a lot of the debt is coming due, and so kind of how they make up their debt, they have 4 parts of it, one of which the maturity kind of varies, 3 of which are coming due in 2026. All of them have fixed rates, so I wasn't as concerned about it being affected by interest rates. What I will say is, so they recently, February 4th, so what, that would be last week, they were upgraded to investor grade credit. So I think that's a huge plus, showing that their free cash flows are going to be, or at least substantial enough to be.
And that wasn't the setup question, I didn't know that, so
Yeah.
That's favorable.
Yes, sir.
Yeah, could you talk to me about your terminal growth rate? I don't have any concerns with it. I'm just curious where you got 1.6%.
Yeah. I think kind of my premise of it was when I was in Dr. Wall's class, he said 2.25 was like the max number, because then you would be outgrowing GDP. So I kind of looked at previous pitches and kind of where industrials companies kind of lay out. Some of them were about 1.3, 1.4%. So I said, okay, well, if I have a clean energy segment, I think that gives you more growth in the out years. And I also think communications is a growing segment with 5G rollout and things like that. So I felt confident at 1.6 as a terminal growth rate.
Thank you.
This is kind of interesting. This may be going beyond what normally we would talk about. You have a 1.6% terminal growth rate. 1 divided by R minus G is a proxy for the same thing as a 1.6% growth rate. And it should be close to what your multiples are. And just doing back of the envelope math is pretty close.
Yeah.
So there's always kind of a way to check to see if the internal long-term growth rate makes sense versus the market. In this case, it passes that test.
All right. Last question, or?
No.
Okay, last question.
Going off Dr. Krause's debt question, have they announced any plans to take on more debt as they expand in the clean energy sector and as they face this 18-month backlog?
So I will say with the Heckles and McCoy acquisition, they expanded their revolving line of credit. I think it was about $300 million, and they upped it by, I want to say $550 million. So, but I will say, I think a revolver is an interesting way to take on credit. I think it's a pretty flexible way of doing such. So, they haven't, to your question, no, they haven't announced anything, but I don't see it really posing any substantial risk in terms of liquidity.
Thank you very much.
Nice start. I keep saying you're going fourth.
Yeah, I thought it was so.
Yeah, I think she's going next. Yeah, Grace. Grace is gonna pitch us on Friday to homes. Same thing, Grace. Talk about how you found this. And if there's a question out there that keeps coming up, handle it, and then we'll kind of delve into the rules.
Yeah, sure.
Thanks.
Hi everyone, my name is Grace McCrea and I cover domestic consumer discretionary. Today I'll be covering Pointe Homes, which has a price target of $29.82, which represents 30% upside. So how I kind of found the company was it came up in a couple of really well-performing small cap funds that I found on the internet, and then it also came up in my screens through FactSet. So then I kind of looked into the company and found that its strategies, which I'll go into later, really were better than those of its peers. And then something that I wanted to address right up front from D2L is I do have a built-in risk premium in my cost of debt. So this should account for inflation and supply chain issues that do come up. So the cost of debt is an average of their future yields from Refinitiv, and this came to about 4% debt. And their, I guess, most recent yield is 2%. So this is about 200 basis point risk premium, like I said, for inflation. And I can go into supply chain if you guys have questions about lumber specifics in the question and answer. And then in terms of interest rates, as of the last earnings call, management said that they have already factored this into all of their assumptions. I know there were some questions about if demand would decrease based on the cost of borrowing being a little bit more expensive. As of right now, management, like I said, has put this into their forecast, but that definitely could be a risk going forward as well. So with that, I'll open it up to questions.
Yes, sir.
Okay, this might I'll back into this question. It'll kind of be walking through it. So, does any of their peers have communities alongside of what TriPoint does? Communities.
In terms of location?
Sure. Yeah, in terms of location.
Yeah, sure. So I should start this by saying that TriPoint has communities, divisions in the West, East, and Central. Central meaning Texas and Colorado primarily. They do have competitors in these areas, so I know that NDC Holdings and KB Home have operations in the West, and then Four Star and Green Brick have operations in the Central or South Texas, but they have not had any competitors with divisions in the East like they do. And this is one of the biggest areas of growth right now for single-family homes. I found that in doing a Google Trends analysis. So this is kind of where TriPoint is focusing their expansion, specifically in Raleigh and Charlotte. They do have communities in DC, Virginia, and Maryland.
Okay. So a lot of times they'll announce a major acquisition of these communities. Are they winning in kind of getting better leverage of deals with their competitors? like in those areas?
Yeah, in terms of acquisitions, not with other companies, but with land.
Land
Yes,
acquiring.
so Dallas and Austin, some of the like most rapid growing areas of Texas are also where they're targeting their expansion. But yeah, like I said, otherwise, North Carolina and Charlotte and Raleigh.
Just kind of piggyback off that a little bit. They said that they're going to like these high growth areas for houses and stuff. Do you know what the population growth has been in those areas over the last few years, or what they're projected to be?
I don't know exactly that number, but I can tell you that like the Google Trends analysis I did, so I searched single family homes at first, and the top 10 subregions of interest were all on the East Coast. And like I said, none of their competitors are focusing on this area, so I can get back to you though.
Growth rate's insane. Those are the fastest growing areas of the country.
Yeah.
Austin is just
Austin.
out of its mind with growth right now.
Right. And I'll just add to that one more thing. So one of my drivers is the asset light land strategy. So they already have land acquired in like Austin, let's say, for those homes that they'll be delivering this year.
Mr. Dewar.
So I have a couple questions.
Sure.
They revolve around your peers and your relative valuation methods. I guess first, why did you elect to use a price to earnings and price to book instead of an EV to EBITDA or an EV to sales? And then could you just defend for me your peer group? I see that Greenbrick Partners, Four-Star Group, are driving a lot of your relative valuation. Could you just talk about why they should be included in this and why the other two fit as well?
Yeah, for sure. So I'll start with, I weighted the DCF 50% and then price to book 40%. And I wanted to do this because it really, I guess, like speaks to my driver about the asset light land strategy as well as the share repurchase. This helps their book value a lot. So I wanted to weight that, in a way that showed that. And then, yeah, price to earnings was the last 10%. And then going into my peer valuation, so MDC Holdings, Greenbrick Partners, KB Home, and then Four-Star are my four peers. And all these companies are really do the exact same thing. The reason that I focused on them is that they focus, just like TriPointe, on the building of the homes. I found a couple other peers that came close, but were more about like the interior design. So I guess that would be why, and they are driving a little bit more.
So did you look at what your valuation would look like without those two peers removed? Because I'm looking at the numbers right now, and those two are driving almost all of your upside, it looks like. So do you have any concerns with that? Personally, I think that may be a little bit alarming that you have two of your competitors driving a lot of your upside.
Yeah, definitely. I didn't look at without those two. I did have, I guess I did add one of those a little bit later. So that you're right, that does drive some of it. But I did do a price to book for 2022 estimates, and it was looking about the same. So that gives me confidence.
Good question. Asset life, was that your second driver?
Yeah.
Is that unique, first of all, compared to other builders? Seems very nice, but options aren't free. Do you know what that costs them?
Yeah, for sure. So it's pretty common strategy in this industry, but they do utilize it, I would say, I guess, better in that they're able to control that growth at least a year ahead of time. So all the homes that they sold, like even like in the fall and winter of 2021, was on land purchased pre-pandemic. So this, like that, for example, had them avoid that 15% appreciation of land prices. I don't know the exact price of the options, but it does come with a down payment. And then on the agreed upon purchase date, that's when they would actually purchase that land. And if they were to back out of it, obviously they lose that down payment. Yeah.
Great job. I was looking on Ibis World today, just home building trends through the industry. There's an 11% growth rate in 2021, but it's expected to drop off in the next 4 to 5 years, at least according to Ibis World. How do you, or rather TriPointe Homes, view the upcoming new home market, and do you think there will continually be room to grow and expand?
Okay, yeah, that's a good question. So right now, they're focusing on, I guess, growth with millennials. That's my first driver, and they represent 54% of that backlog right now. So they're not at all worried about demand for now. They're getting 4.9 orders per community per month, which is substantial growth from last year. I believe it was 4.1. And they're able to fulfill these orders. They're selling 4.1 homes per community per month, which is well above their sweet spot of like 3.5, they say. But in terms of looking forward, the company hasn't disclosed like 5 years out what their projections are, but I believe it will be strong, especially with millennials continue if this work from home continues, for example.
And I'm going to throw the last question at you. It's going to piggyback off to Dr. Krause on the last one. This company's pretty leverage heavy. That's how you're keeping your WAC low, right?
Mhm.
So you combine some threats to the idea that maybe millennials will be willing to pay all-time highs in housing. Maybe they won't. But at the same time, I'm going to be asking them to pay the highest interest rates that any generation has seen for 30 years. Does that combo cause you any concern? Or let me ask it in a way that would be more numeric. Did you adjust your WAC or your basis points at all for the fact that we seem to have some rate hikes coming in an environment when they've got debt that's constantly needed to revolve to build all this housing?
Yeah, for sure. So I'll start this by saying that their buyers can lend and like get their mortgage financing from anyone. TriPoint does offer mortgage like servicing called TriPoint Connect. So yeah, I did. Like I said, management has put this into their expectations of demand already. So
But
I
did
was
you do any kind of risk adjustment in terms of a risk premium or any kind of cash flow adjustment for rate hikes? Or do you know what their debt schedule looks like? Is it not a concern because everything's not due for 20 years?
no, their debt schedule stuff is due 2024. That's the soonest year. And I didn't do a risk premium specifically for that, but I was pretty conservative with the demand in my revenues because like fiscal year 21, the fourth quarter hasn't come out yet, but I was conservative going into 22 and 23.
Good. And for your buy sell, you could include an analysis tomorrow
Yes.
if you'd like.
For their interest rates.
Yeah, no worries. Thank you.
All right, thank you.
All right, next up, we got a jazzy one. Yeah. DJ Jazzy Jeff. Danny, come up and talk us all about this Jazz Pharmaceuticals. How you found it? Right. Looks like they're in Dublin. Were you over there? Were you listening to some nice Irish music? Taking your favorite pharmaceuticals? Yeah. Yeah, sounds good. Walk us through how you found it, and then if there is a lingering question, everyone just keeps asking if you feel like they're not getting it, or there's something you want to address, take it from there. Thank you. Thank you, Dr. Wolf.
Yeah, so I'm pitching Jazz Pharmaceuticals today. How I came about finding them really came from my first pitch. As a pharmaceutical company, what really drives their growth and forward-looking margins and everything starts at the top line with their products. So I came across Jazz, which specializes in rare diseases, mostly associated with narcolepsy and cataplexy, which are sleeping disorders. So pretty rare market to operate in, and they've had 16 consecutive years of revenue growth, but I noticed they reported a net loss this year. So I found it as a very interesting company after doing some more research on it. Kind of found it to be a little misunderstood, perhaps, and have an interesting price target, considering it dropped pretty significantly, about 30%. After the acquisition, a large acquisition of GW Pharmaceuticals. So that acquisition obviously drove in a lot of acquisition-related expenses. And on a GAAP basis, they reported a net loss this year, but still were able to maintain revenue growth. So the acquisition of GW Pharmaceuticals adds a third high commercial product line in Epidiolex, which is an interesting product I'd like to get into. And it brought in about just $800 million of acquisition-related expenses, primarily related to intangible assets and fair value step up of their inventory. So that really is what drove down their operating margin and reported net loss of $300 million this year. On a non-GAAP basis, minus unusual expenses, if you take out $800 million, about 500 million of which was related to intangible assets, they would have projected to report about net income of 540, which is also a growth from last year. So obviously, I've got a lot of questions about my ratios in my boxes, specifically ROA, ROE, and ROIC, which are all negative. Again, that kind of comes from the net loss. So if we look forward-looking with further integration of GW and further synergy, we can see ROA kind of return to normal levels. Their assets grew double in size. They have about $12 billion in total assets right now, most related to a lot of goodwill and inventory from the acquisition. So ROA is expected to get back to normal levels around 2024 of about 9%. And then ROA and ROIC, for ROE, that's expected to get back to normal levels in 2023, about 20.5%, which is industry normal levels and historic normal levels for Jazz. And ROIC, those calculations came in pretty well. The return on invested capital next year is projected to be about 6.6, which already surpasses their WACC in a year, and then return to 8.6 in 2023, which is at normal levels. So I can go into that further and take any other questions.
Do they have any drugs in development?
They have a lot. Their pipeline is quite large right now. It's expanded 4 times since 2015. They have 5 currently in phase 3, so those are really close.
What percentage of phase 3 drugs have they taken through to the market in the past?
They actually just passed Rylaze in the past week.
I don't want to know what they did.
Yeah.
I want quant, right? So did you model any of that into your future assumptions?
Yeah, so they have over 50% of revenue comes from newly launched products since 2020.
Yeah.
So that's about, of their portfolio, that's about 40% of new drugs passing phase 3 and FDA approval.
And so did you take these drugs and run it at a 40% pass rate and then scale it out?
I did not. They've recorded.
This is your first pitch, right?
Yeah.
No problem. Next pitch, if you stay in this sector, please come see me. There's a way to do this. It's been done real well in this room. You're doing a good job. You took baselines, not a problem on the first pitch.
Okay.
But we usually want to look at what that pipeline looks like. What's the percentage win rate? Model that into our future assumptions. It's not an error made. He used a very good assumption. He just took their baseline of what they've done and applied it forward. And that's actually a very valid method. So no error, no foul. Just one.
Yeah, great.
Yep. Yes, sir.
Don't know a lot about this sector, so kind of just walk me through who their current central pharmacy is, how often it is for people to, or for these companies like Jazz to switch over central pharmacies, and if that varies based off of that.
Yeah, Jazz has had the same central pharmacy for the past 8 years. They've done well. Their supply chain issues are pretty limited, pretty normal with current issues. So that risk is associated with further implications of supply chain issues, mostly related to Xywave and Xyrem, their top line products for revenue. So that risk is really not material right now, but the potential to do that is possible, and it would drive up, could potentially drive up costs of contracts and obligations with issuers and payers.
What I'm really trying to get at is like, is it plausible or possible for them to get dropped, or for their central pharmacy to have more leverage on them compared to?
Jazz controls a lot of controls the leverage with their central pharmacy, where that central pharmacy where their biggest customer, by a lot, we control, I think, 65% of their distribution in the U.S. So the risk is associated more with Jazz dropping them versus vice versa.
Perfect, thank you.
Yeah, great job here. Really like this company. I'm pretty familiar with it myself. I have a couple questions about their capital structure. So first, they have roughly 60% debt equity, correct?
Mm-hmm.
How did you model out their debt schedule? What do their issuances look like? Is it fixed rate, floating rate, and what problems do you see with everything?
Yeah, so they've obviously taken on a lot of debt related to the acquisition. So their debt schedule is pretty laid out. They have notes due on 2024 and 2026 and 2029. Those are at rates, a weighted average rate of about 4.4%. And then about $3.5 billion of their debt is on a floating rate term, which is a little concerning, but their goals to deleverage are of the utmost importance right now. They paid off nearly $500 million of debt in the third quarter of 2021. Their goal is to get to a net leverage ratio of 3.5 times by 20.
Yeah, so I'm a little bit concerned that they issued debt for this acquisition. Typically in pharmaceuticals, you'll see they'll use cash on hand. Are they having liquidity issues? Did you look at a Z-score analysis for this company potentially?
I did not look at the Z-score analysis. They did use a significant portion of cash on hand, and they acquired this through the acquisition of GW shareholders. So to deleverage to 3.5 times by 2022 is their plan. I took a cautious approach. Have that at 3.75 by the end of 2022. So their debt structure right now is centered around very favorable options with no prepayment penalty. So they've already exercised that, like I said, $578 million in the third quarter of 2021. So we can expect that to continue throughout the year. Again, it's kind of hard to forecast, when the prepayments are going to come in what quantity because they don't really clarify. It just kind of comes with the generation of cash flows, which are going to be strong moving forward with their top line revenue growth. So,
The question about the Z-score, for those of you who will be presenting in the future, we are heading into a period where balance sheet, debt, interest rates are going to matter. We have rising rates. I mean, pretty much 7 rate increases expected over the next year and a half. The Z-score, I mean, we should talk about actually maybe even including that now in our box.
Yeah.
It's an important metric that we haven't had to worry when interest rates were zero and the
Every
economy.
person in this room's had to do it at least once.
Yeah. So, good question, and
Well,
maybe
we'll have
the Z-score is something to be including in future pitches. Who knows, maybe even on the box.
The M score. Did you run the M score?
I wrote no letter score.
So, this, you talked about the price decline of this company. How did the peers perform from a market standpoint over this period of time? Did you look at that?
Yeah, so they've declined slightly, not at the rate of Jazz. Industry average, at least in 2022 for revenue in terms, just to touch on that briefly, dropped about 46% due to COVID-related issues, which was what Jazz was at roughly. But in 2021, those grew, back to normal levels. But in the past year, industry average prices have fallen about 8%.
Here's a quick one. This goes right back to the first question. R&D. It's always good to hear that companies like this are spending in R&D. You said 10%?
Of R&D?
10%. The R&D expenditures are 10% of revenue?
No, they're much higher actually. Right now they're at 16%, which is along the industry average. And I actually have that projecting forward or projecting up in the future with a much bigger pipeline and further indications of current drugs.
Yeah,
So-
Anders, you got a quick one?
Yeah, back to the pipeline. Could you tell me what stages most of the drugs are in right now and what, any updates or any good, bad news on them?
Yeah, so they have 5 current drugs in phase 3 right now. So they'll focus on that mostly. 3 of them are related to Epidiolex, which is actually a CBD product. That has gone tremendously. Epidiolex is the first FDA-approved CBD treatment for multiple seizures. So in phase 3, the next really promising development is with a variation of Epidiolex with related to spinal issues, spasticity, which is basically just muscle tightness, which kind of contributes to their specialty in sleeping disorders. And we can expect so that's expected within the next year. And then for Zipcelca, which is their leading oncology product, which treats small cell lung cancer, they have 2 further indications coming within the next year. And that currently has a 37% market share of treating small cell lung cancer, which is the highest percentage. So we can expect that to grow too with those further developments of Zipcelca.
Thank you. Payne is ready to talk to us about a very, very clean business, Clean Harbors, which likes to like clean up very, very dirty things like oil.
Yep.
So if you could talk us through how you found this company, as well as if there is a lingering question out there or something you just want to address because you feel so moved.
Yeah, of course. So, my name is Andrew Payne. I'm a junior in the AIM program. So just to take everybody through my screening process, so I kind of took the same approach as Michael. I was kind of just reading through industrial companies. I was looking for companies that were leaders within their industry and were looking to grow into other markets. So Clean Harbors really stood out to me because they had actually, Clean Harbors, their acquisition strategy really stood out to me because they had taken their second line of revenue, which is Safety Clean, acting as a subsidiary, which they acquired in 2011, and really completely moved it out of the market that it started in, and then it had operated in for 30 years and grown into the oil re-refinery market that it really is thriving in right now. So that's kind of how I chose it, and I just really liked it. Held the historicals, and before 2020, they are a environmental waste disposal company and the largest hazardous waste disposal company in North America. And they took some hits in 2020 because of COVID, because they are the revenue is very volume driven. But they really did not take as much of a hit as they should have, because they completed over 20,000 COVID response jobs and emergency cleanups to really help bring the revenue back up above the industry average for companies dealing with environmental waste disposal. So to address some questions that I got asked, and one thing I looked on my write-up as well, they do 87% of the revenue in the U.S. and 13% is broken off in Canada. So I just want to clear that up. But one question I got asked a few times in D2L was my return on investment capital being lower than my WACC. I had some concern over that. And kind of explanation I gave for this is, so in 2020, third quarter, my company made a major acquisition, issued $1 billion of debt to acquire Hydrochem PSC, I'll refer to them as Hydrochem. And they started integrating them into their financial statements in the fourth quarter of 2020. So what I did was I split their revenue, or divided their revenue and EBITDA by 4, added it to their income statement, and then added the $1 billion of debt as well. So that's what really was driving down my ROIC, and I actually took that acquisition out, estimated what Clean Harbors revenue was going to be for the fourth quarter, and I came up with a ROIC of 7.77, which is greater than their WACC of 7.48. And the last thing I want to address is we are highly leveraged. Like I said, they just issued $1 billion of debt to finance this company. And I just want to go over their debt schedule really quickly. So right now they have $2.5 billion outstanding debt. Management's projected this is going to be in the low 2s after full fiscal year 2022. They have $713 million due in 2024, $545 million due in 2027, $1 billion due in 2028, and $300 million in 2029. And the two most recent debt payments are on floating term loans, and the ones due in 2028, 2029 are fixed notes at 4.8 and 5%. So with that said, I'll open up to questions.
We'll do a little valuation here first. I do see you use the PE, but only 10%, and I know why, because looking at that peer table, they're all over the place.
Mm-hmm.
Enterprise value to EBITDA, a little more control. Have you looked at historically, pre-pandemic, what this industry looked like from a multiple standpoint?
Yeah, so I was seeing historically, I'll answer your question first, and I kind of want to get into I took a company out that's giving me a lot of upside. So historically, Clean Harbors PE has been floating around 22 to 32 range, and that's on par kind of with their industry. So as you can see, like Stericycle right now is at 142. Historically, they've been much lower, still high in the 50s, 40s and 50s. But all these other companies like Harsco Corporation is much higher than they usually are. They tend to range in the 30 to 40 range, and then like U.S. Ecology reported a loss, so they're at -9, and they're just kind of all over the place, and kind of hurt that 2020 there was so much volume lost is kind of an unpredictable. And then also just in choosing my peers in general, it's kind of a difficult process because they're involved.
Clean Harbors is involved in oil refinery, which makes up 20% of the revenue, as well as environmental waste disposal, and there's just not a lot of companies that offer both those systems. And a lot of waste disposal companies are really narrowed in on one specific industry. It's kind of tough to choose. I kind of just saw the companies that they were listing in the transcript as their competitors.
Take us away, Joe.
So
We beat you this time.
thank you for answering the debt question I had on B12 and stuff, but I just want to follow up on that. They have a lot of debt that's due within the 10 years, as you just mentioned. Are they capable of paying that debt off, or what is their liquidity ratios looking like? And are you confident they'll be able to pay that off without reissuing, or are they going to reissue the debt?
Yeah, so they have an EV to EBITDA under 10, which I thought was a good metric to use. And they've done historically, so in this past acquisition of Safety Clean, they issued the exact same amount of debt and it was the exact same purchase price. They used the exact same amount of cash on hand. And it was also a term loan. So they did a really good job of paying as much debt as they could off when they had high levels of cash on hand, paying that debt off early, and then kind of just making smaller payments in the final 3 years of the loan.
Yes, sir.
I noticed that there was a cancel.
Yeah, you're fine. Go ahead.
Just call it. You talked enough. I noticed that there was a cancellation on the acquisition of Vertex Energies. Do you know much about that, or could you elaborate?
Yeah, so this was a bit peculiar. So the earnings report for the full year has not come out yet. It comes out February 22nd, and Vertex has not come out until March. So I was kind of just relying on reading some articles and doing some research on my own. So what I do know is the acquisition was to add on the Safety Clean portion of revenue. It was $140 million all-cash transaction to acquire 2 re-refineries, building onto the re-refinery segment of revenue. And they had a first, so basically how it works is they submit their financials to the Federal Trade Commission. It got denied the first time, and they wanted reapproval, which management said was extremely rare and that they had barely ever had happen under. So that was kind of pointing to signs of Vertex having some problems. And then Vertex actually paid, it was called a kind of mutual termination, but Vertex ended up paying a breakup fee of $4 million to Clean Harbors. And then also when the deal was announced, Vertex's stock dropped 11% and Clean Harbors up 2%. So there's not a ton of extra data out there on what really transpired, but I'm sure I'll be informed of that when the furniture board comes
So
out.
go over there. We'll save it.
Just a question, Chairman and CEO and President Alan McKim, so he founded the firm, he's been with them since their inception. So he's over 65 years old now. Is there a succession plan in place for him? And what does the rest of the management look like in terms of experience and makeup?
Yeah, so I did not read anything about somebody taking over for him. But their average tenured executive is 14 years. Take him out, it's been there 40 years, still 10 years, so still pretty strong. They just hired a new not just hired, their CFO has been there for the past 8 years. The CEO has been there the past 12.
Thank you.
There you go.
Sure.
I got a fun one. I'm feeling impish.
Cool. I was gonna say, it seems like very based off the acquisitions, Joe kind of touched upon it, but what are kind of future areas that management is looking towards, and are they gonna be able to finance that future acquisition and growth stages that they might have?
Yeah, so good question. So they're actually trying to increase their incineration capacity. So right now they're currently operating at 570,000 tons incineration capacity. They have 9 incinerators right now, and there's only actually 85 operating incinerators in the entire, in all of North America. And they're actually still trying to grow that. So over the next 5 years, they're trying to add 3 incinerators. One, I've already built into my model an extra $200 million of invested capital in 2024, and an additional $90 million of invested capital in 2025 for that.
Some more internal kind of building.
Yes,
Okay,
correct.
Perfect, thank you.
So I'm going to ask both of you this question, but I'm going to ask Michael first. I noticed we have 2 stocks, domestic industrials. Both are about the same beta. They're both about the same whack, and oftentimes we can only add one of them to the portfolio. Michael, why is your stock better than his?
I'll actually take the alternate approach. I think both of them are very good.
Look at the gentlemanly answer. See if we responded kind. You're getting your 20 seconds.
What I will say is, Andrew and I have talked together about what companies we feel like don't fit in the portfolio any longer. So I will be proposing to sell Columbus McKinnon as well as Trex. Trex has been down 36%, and then Columbus McKinnon, I was just kind of going through some stuff, and I since it's been pitched, it hasn't been past the price that it was actually pitched at, that current price. So I think really nothing has played out, and I think it's time to kind of sell those two companies. And then
What a gentlemanly answer.
Yeah.
Andrew, your
Yeah,
kids.
I mean, Mike and I, kind of the same. We were talking about kind of what companies do not fit in the portfolio anymore. So we chose, it was a little overweight, so we are both planning to sell recommendations for two companies, along with our buy recommendation.
All right. Any last questions?
we're also overweight in industrials. I think that's.
Oh, yeah. They always want to. How's it worked out historically?
I can tell you.
All right, fair enough. Thank you, gentlemen. We're going to have this great Matterport presentation in the metaverse. I'll set up on my end. I saw Bassel in there. I think Dr. Cross will be here shortly. Are we having Jess kind of, you're going to set this up, Jess? You know how to record it?
Cross is recording.
Okay, great. So I'm going to attempt to moderate this headset on, which means basically, so I don't